everyone. Look, I hope everyone is doing well and you're coping well with the last couple of months. It's good to see that the evenings are getting a bit brighter and we're having the odd sunny day, which is making things a bit more bearable. So look, today's webinar is, essentially from my years working in the industry, what I would deem to be, the 6 key steps that people can take to accumulate wealth. And I'm just going to share my screen with you there and just kind of run through some of the slides. So, bear with me. Okay, so today's webinar, guys, is 6 easy steps to building wealth. You're all very welcome, and thanks for taking the time to come on. And when I speak about building wealth here, I'm not saying that we can turn people into millionaires overnight. But what I am saying is that there's certain steps that people can take with their own finances to become more financially independent. And when I say financially independent, that might mean different things to different people. But in my mind, it's just being more confident in your overall financial picture, that maybe you have, you're more comfortable with your day-to-day spending, that you have, emergency funds set aside if you, couldn't work, God forbid, that you have savings and investments working long term. So, for any of the expensive things that life might throw at us, like kids' education and weddings and these types of things, that we have money there to allocate to that. And even going into the longer term goals, that we have money to maybe potentially clear our mortgage in our later years, or, enough money to retire early. So just before we kind of go into things, I just wanted to give you guys, a quick introduction to myself and who Alpha Wealth are, for those of you on the call who don't know. My own name is David Looney. I work as a financial advisor, and I've been working in the financial services industry for about 7 to 8 years now. And we run essentially a financial services company down in Cork, out of Little Island, and we have 6 advisors there who offer complimentary financial reviews to clients and offer them advice in 3 key areas of financial planning, which are savings and investments, retirement planning and pensions, and protection insurance. But we also delve into many other areas for clients, such as mortgage advice, tax advice, and anything else within that kind of personal finance space. So to delve straight into today's webinar, as I said, it's all about taking steps to ensure we reach kind of financial independence. And the way we can do that is by allocating some of today's money to the future and ensuring it's in the right place. And that might seem like a very simplistic phrase, but let me get to it in a second. But before I go into the 6 steps, I just wanted to kind of hone in on a couple of things to appreciate. Firstly, this is not a get-rich-quick scheme. I genuinely do believe that everyday people on average incomes can build wealth and become financially free. And I believe it's all about how we manage our money with the right advice. And the reason I say that is because in my years working in the industry, I've met thousands of clients, and I meet people that, are paying for childcare, paying for mortgages, paying for bills, and they still afford to set money aside in savings and investments and pensions and, live a comfortable life. And then I meet people on big salaries, and they say they can't afford to do stuff, and they're struggling financially, which makes me believe that it is a case of kind of money management. The second thing I would say is you do need to buy into this process. I mean, everyone here has taken time out of their Friday to come onto the webinar. So look, you might as well listen in, make it count, and maybe try to apply it to your own financial situation. And I would like everyone on the webinar to be open-minded, and maybe kind of, break away from some old misconceptions that you might have. I hear a lot of people saying that like investing isn't for me. And I think that mindset kind of puts you at a bit of a disadvantage. And financial planning is a long-term plan. It's not a quick fix, as I said. And you don't need to have a knowledge or interest in this to benefit from it. That's what people like myself and my colleague Nick, who's also on the webinar today, are here to help you guys with. And look, it is really important to get proper, unbiased advice. You can have the best intentions in the world to set your finances straight, but unless you're getting the right advice, you're kind of, you know, fighting a losing battle. I have a bit of a love-hate relationship with my own industry, in that, you know, it can seriously improve people's lives if done right. But I think there's too many sales reps in the industry who offer poor advice and overcharge. So whether you get advice from Alpha Wealth or anyone else, I don't think it matters, but make sure that you can deal with someone, you know, trusted and you know, build a long-term relationship with. So getting straight into things, you know, step one for me is getting into good habits, because I think as an industry, we're always telling people that you need to save or you need to put money to pensions, but we don't, you know, really enable them to do that. So the first two steps are all about freeing up disposable income to allocate to future plans, because financial planning does start with planning. And one of the things that people can do, and it's something I would encourage everyone on the webinar to do, is set out a monthly budget planner on Excel, where you put in your income, you put in your outgoings, and you see what you have left to allocate to, you know, future plans. And it might seem quite simplistic, but it works. And I'd recommend that people do this with 6 months of bank statements. And the reason for that is it'll give you a clear idea of how you're spending your money, and it'll help you identify certain spending patterns. And, you know, it might be a case of looking and seeing if there's some small areas we can make sacrifices in to look after our future. Because at the end of the day, money does come with a set of choices. Look, I know things are tough at the moment, particularly for some people working in some industries, but for some of us, you know, our money does come with choices and our income does come with choices. Like, we can decide to spend 100 quid a month on takeaway coffees, or we can forego that and put it to, you know, a savings plan for our kids' education, which will prevent us taking out a loan down the line, which essentially eats up even more of our income. Now, before you know, judge me, I'm not Mr. High and Mighty that thinks people shouldn't drink takeaway coffees. You know, I'm probably spending a fortune on them myself at the moment, just because it's probably the only thing to do to get out of the house and go for a walk and get a takeaway coffee. But the reason I put this slide in here is to make people appreciate that if you really want to do something, you'll find a way to do it. If you can't free up disposable income in looking at your finances, you can free up disposable income in looking at the things that you pay for and looking to reduce costs in them. Some of the main things, obviously, that we pay for and pay quite a lot for are things like insurance policies and assurance policies, things like, you know, mortgage repayments. And what I always say to people is it's really important to review these policies and shop around, because you can save a fortune doing that. And I don't mean just ringing up one or two companies. I mean actually really, you know, shopping around and trying to get the best, I suppose, solution for you in every aspect of what you're paying for. Alpha Wealth can help in this, because we provide independent reviews of all these types of things. And because we're not a tied agent, we deal with all the insurance companies in the market for things like mortgage protection and life cover and illness cover. We can often get people discounts that they can't get directly going to those providers. And I meet a lot of people that say, you know, Jesus, I can't, you know, I'd love to put €75 per month to a savings plan for my child, but I can't afford to do it. And what I would say to them is, let me look at your finances. And if you can't afford to save €75 per month, I will save you €75 per month so that you can. And the two first areas I would recommend people to look at to do that is, firstly, the mortgage rate that you were paying, and secondly, the health insurance plan that you were on. Interest rates have come down quite a lot in the last couple of years on mortgages. So, you know, we're seeing rates of, you know, 1.95%, 2.2%. So for anyone who's paying north of that, you're probably paying too much. And, you know, I believe strongly that, you know, ignorance is not bliss when it comes to your personal finances. And I would recommend everyone on this call, if they don't know their mortgage rate, to take out a mortgage statement tonight or request one from your bank and look into it. Because I have come across clients that are paying rates of 4.5% in this example, and they can switch to a rate of 2.2%, which saves them €300 per month, or €18,000 over 5 years' time. So it's not something to ignore, and it's something that, you know, can save you tens of thousands of euro over the long term. And what you decide to do with that is up to yourself. The other area, obviously, is health insurance, which is a complete minefield. There's over 500 plans in the market. And there's plans that cost €1,200 a year, and they provide less benefits than plans that are €800 a year. So again, it's an area that you can definitely save a lot of money on. Just kind of giving you guys an idea of the different mortgage rates that are in the market today. Bank of Ireland 3%, going down to the kind of mid twos with AIB and KBC. EBS 2.9. Some come with cashback offers, some don't. So you could potentially switch your mortgage to another bank for a cheaper rate, as well as a cashback offering, which is quite attractive for a lot of people. But you don't even need to switch your bank in a lot of cases. Some people can even move to a lower rate within their own banks simply by making a phone call or ticking a box and sending a form back to your bank, and therefore saving yourself a lot of money. Avant Money entered the mortgage market last year, and they're now offering rates of 1.95%. So if you're paying north of that, you need to review your mortgage. Okay, so after kind of freeing up disposable income through looking at our the way we spend our money and the things that we pay for, step 3 for me is about embracing investments and putting that extra money to work. And I think this is an area that a lot of people in Ireland particularly fall down in, because they have a bit of a misconception about what investing is. Investing to me, is just a steady way of growing your savings, just getting a small, decent, steady return. And people need to appreciate that we have over 120 years of data, which shows us that the stock market moves upwards over the long term. So you should use that to your advantage, and you don't need to understand it to use it to your advantage. And successful investing is based on concepts of diversification, time, and keeping costs low. Obviously, diversification is spreading out your risk. And when I speak to clients, I usually speak about, correctly structuring their savings. And we speak about kind of 4 or 5 year rules. And that is for any kind of short-term savings, you should keep it in bank, credit union, post office. But for anything long-term, like savings that you don't need beyond 4 or 5 years, you should be investing that money, because interest rates on deposit, and when I say deposit, I mean bank, credit union, and post office, are practically nil at the moment. And inflation is just eating away into the value of your savings. So you are actually losing value in real terms. I think it's particularly important for like kids savings. I meet a lot of parents that are saving their child benefit into the post office, and I can't fathom why somebody would do that for potentially 15 to 18 years when they're only earning 0.5% per year, and inflation is projected to be about 2% per year. And this man down at the end of the screen here, who some of you might know, is Warren Buffett, who's one of the most successful investors of all time. And he had a lot of famous sayings, but one of them is to, not take short-term results too seriously and instead focus on 4 or 5 year averages. And this is coming back to the point that I'm making, that, it's about putting long-term plans in place, because we know that markets can be volatile in the short term, but in the long term, they generally move in an upwards trajectory, and people that stay invested long term have always got results. I think we are prone to kind of a lot of bias when it comes to things like this. And over on the right hand side, it's just some of the kind of the challenges that I want to focus on, some of the challenges that I come up against on a daily basis. I hear people saying that you need loads of money to invest. You don't. There's quite accessible long-term savings plans in the market that can be started from as little as €75 per month. That's less than 20 quid a week. And the concepts of investing €75 is the exact same as investing €75 million. So you don't need loads of money to benefit from investment markets. I hear people, saying that you need to know what you're doing. I was speaking to a friend last week, actually, and he was asking me questions based on what I do. And I told him some of the kind of savings plans that I'm using myself to grow my own savings. And his response was, Jesus, I'd love to be doing that, but I wouldn't know where to start. I wouldn't know what to do. The key thing here is you don't need to know about investing to benefit from it. There's loads of really hands-off options that are available in the market. And I'd be conscious of, being too vague with stuff, saying that investments are, super risky, tarnishing them all with the same brush. I'm not delusional. I do know investing can be risky, but there are some very tried and tested investments out there that, in my mind, will get people a decent, steady return over the long term. And then there are some really, really high risk investments. And you know, I hear people saying that their friend or their uncle or their neighbor lost money in an investment, and that shouldn't be an excuse not for you to explore investments as a whole for a way to grow your own money. The next slide here just kind of signifies the importance of having that long-term plan, because we know markets can be volatile in the short term, but in the long term, they've generally moved in an upwards trajectory, and it's up to us which one we focus on. You know, I'm a keen believer that if we start, you know, a savings plan or a pension plan, which could potentially be, you know, 10, 20, 30 years, and people are saying to me, Jesus, we could potentially be going into a recession. Why do you care? You know, it's going to be a long-term plan. You shouldn't care what happens in the next 12 to 24 months, as long as we're doing the basics right. One of the, you know, best savings plans for me in the market that somebody can utilize to, you know, benefit from investing in a very hands-off and accessible way is Zoric's Easy Access Savings Plan. And firstly, let me just say that I have absolutely no ties to Zoric. We can arrange savings plans from Zoric as well as every other savings provider in the market pretty much. But I'm recommending it on the basis that I believed it to be the best of its type. It basically allows you to save as little as €75 per month or a lump sum of €5,000 per month. It's really flexible in that you can increase, decrease, stop and recommence it at any stage, or withdraw out your savings at any stage. And you can invest your savings in over 30 different funds from Zoric of varying risk and reward levels, which can be changed throughout the term. So there's something there for everyone. And as I mentioned, it's a completely hands-off way of benefiting from investing. You don't need to know anything about it. You just need to reach out and get the right advice. And a plan like this is ideal for children's allowance. The majority of my clients would actually use it to save their child benefit into. And I, you know, get a lot of people saying, Jesus, you know, I can't afford to put €75 per month into a plan for my children's education. And Zoric actually done a survey a couple of years ago, and they found that 50% of Irish parents say that they'll rely on loans to finance education. And I think that can be avoided by planning early on. And what I would say to people is that if you can't afford to save €75 per month now, how are you going to afford to pay potentially 200, 300 euro per month down the line in loan repayments? So it's all about, you know, planning early on. This slide is a bit heavy, so look, apologies in advance, but what this is that it just shows the performance of some of Zoric's various funds that you can choose from. Their Prisma funds here at the top are kind of their house funds, and they're categorized on a risk scale of Prisma 2 to Prisma Max. And what I'd like for people to hone in on is the Prisma 4, which is their medium risk fund. And if you look at how it is done over the last 3 years, it's 8.5% per year. And the reason I'm picking that is because last year we had COVID came about and a global pandemic and a massive shock to the global economy and a massive drop for financial markets and a quick recovery, obviously. And this fund throughout that still managed to achieve returns of 8.5% per year over that period. The image here in the middle is what the Prisma 4 is made up of. So it's spread across many different asset classes. So you have equities, which are stocks, making up about 57% of it. You have some government and corporate backed bonds, property, and alternatives. And I think, you know, our industry has a tendency to just throw these kind of, I suppose, words at people without really taking a step back and looking at what they mean. Stocks is basically you owning a tiny piece of companies. So if you look at some of the biggest and most profitable companies in the world, such as your Apples and your Alphabets, which is Google, and your, you know, Johnson and Johnsons, and hundreds of more companies like this, you're essentially owning parts of all of these massive companies within a fund. So I struggle to see how somebody could be so nervous about owning parts of the biggest and most profitable companies in a fund, but they've no problem owning one investment property in one town in Ireland and leasing it out to one person, and it's completely illiquid. I mean, that property, as we've seen in 2008, will fall a lot harder than this fund will. And more importantly, this fund will pull it back and has pulled it back a lot quicker. So it's about diversification and spreading out your risk. Another fund from Zoric that I wanted to mention today is Zoric's Balance Fund. And the reason I'm mentioning it is that it has over a 30-year track record of delivering annualized returns of 10% per year. So if you think of what this fund has been through, you're talking 2 recessions, COVID, and everything in between. I struggle to see how somebody could have an argument against investing in this fund or using it as a means to grow their money over the long term, given its track record. And the way that essentially you're benefiting from a plan like this is that it's allowing you to make returns through compound interest, which Warren Buffett described as being the 8th wonder of the world. I mentioned about using a plan like this for kid savings, and this just illustrates, if somebody would have used a plan like this historically, what they would have come out with. And as I said, it's about planning early on. Kids typically start college at 18, and I have clients that would decide to put their child benefit into it when the child is born. And if somebody done that, saving €140 per month, the child benefit has now gone up to 145, I believe, they would have had €42,000 by the time their child was 18. And it doesn't even need to be used for third level education. You can use it for whatever you want, but at least your money is growing for you and you're accumulating wealth. If somebody was in a position to have a lump sum of money, they could have put 10,000 into an account like this, as well as investing €140 per month. And mind you, it was completely flexible. You could increase and decrease and stop and restart, or pull your money out at any stage. And after 18 years, they would have had 56,000 to use for child benefit, or sorry, to use for their children's education, or any else other thing that they might use wish to use that money for. So step 4 is being tax efficient in everything that you do. And I want to talk about something that I'm going to refer to here as the super special tax efficient long-term savings plan, which is the single most effective way to build wealth. It's extremely underused and extremely underappreciated. And how it works essentially is you can save into it monthly or annually, and for every €60 you put in, the government would top it up by €40 if you're a higher rate taxpayer. So you get €100 going in for a net cost of €60, which is a guaranteed 66% immediate return. If you're a standard rate taxpayer, you pay 80, government pays in 20, so you're turning 80 into 100. Now, if you work for a company, your employer might also top it up by 100. So in this example, you could turn €60 into €200 immediately, which is a guaranteed 330% immediate return. And the thing is, you decide exactly where the money goes. You can put it into a bank deposit account. You can put it into stocks. You can put it into some of the Zurich funds I mentioned earlier, property, and even cryptocurrencies now. If it earns any interest in any of those things, it's all tax-free. So if you can imagine the power of 20 to 30 years of completely tax-free compounding interest on all that money being paid in. And in your later years, which is actually from age 50 onwards, typically you can access this money. You get to take it all out as you get to take out a large portion of it as a tax-free lump sum, and the remainder goes to provide you with ongoing income. Many people on the call will probably know what I'm talking about here, and many people might have one themselves. And what I'm speaking about is a pension. And the reason I've described it this way without referring to the word pension is because people have a tendency to get turned off pensions the very minute they hear the word. But this is essentially what a pension is. I remember I was doing a financial clinic in a large company in Cork before COVID who had a company-sponsored pension scheme. And one of the employees told me that they weren't, they didn't sign up to it. And when I quizzed them on it, they said, oh, pensions are a disaster. So this person had an opportunity to turn each €60 into €200. They could invest it wherever they wanted, and there was quite a couple of funds. I was familiar with the scheme, and they had some really decent funds in there that done 8%, 9%, ongoing, really well diversified, well managed. So she had the opportunity to get a 330% immediate return, benefit from funds that were giving 6, 8, 9% per year, and take out a large portion of a tax-free retirement. And her notion of that was that it was a disaster. And when I quizzed her on it a bit further, it transpired that her uncle back in Poland lost all his pension in some dodgy overseas property fund. And I think this is where we go wrong as an industry, because we look at pensions as an investment rather than a vehicle. Just like you can lose money in personal investments, you can also lose money in pension investments. And it's all about what you do with your money, and it's completely up to you. But if done right, there is no better way to accumulate wealth, as you can clearly see. And as I said, you can typically access pensions from 50 onwards, and take early retirement. If there's any people on the call that have built up money in an employer's pension that they have now left, you can move that to something called a personal retirement bond, which simply moves the pension into your own name. You don't have to go ringing up the company in 10, 20 years time to ask permission to retire from it. It's completely up to you. You know, you've control and full transparency over it, but you can access those funds from 50 onwards without, you know, the needs to go back to the company. And this is something that Alpha Wealth can help with if there's anybody who wishes to look into it. The other scheme that I want to speak about from a kind of tax efficiency point of view is something called the EIIS scheme, and that's actually the name of it. It's a revenue-backed scheme. It stands for Employment Investment Incentive Scheme, and it basically allows you to invest a sum of money with a qualifying Irish company. And the reason you would do that is that revenue would kick you back 40% on anything that you invest with that company. And you'd also get a return from that company for the use of your money over a 4-year period. So it's typically a 4-year scheme. Every year there's thousands of companies that raise money under the scheme, and it represents a really powerful vehicle to be utilised alongside our pensions to reduce our tax bill and grow our money. And you can invest as little as €5,000 per company per year. And there's some really, really solid companies which are over on the right-hand side. Some of you might be familiar with Kinsale, Kinsale Spirit Co. And Red Earl Irish Whiskey, if you're from Cork. Just to give you an idea of exactly how it would work, if you invested €10,000 in an EIIS company this year in 2021, what would happen is in next year, revenue would issue you with a 40% rebate. So it's 4,000 coming back to you, which would make the net cost of that investment €6,000. So you invested 10,000, you get 4,000 back from revenue, and you say 6,000 left within the scheme. In 2024, which would be the 4th year of it, you get €10,000 returned plus your initial 10,000 plus 30% interest from the company, which is a typical interest rate from the scheme. So you get 13,000 back, all going well. So if you look at that, you made a net investment of €6,000, and in 4 years' time, you're getting €13,000 returned, which is a massive return. And you can do this every single year. I have clients that just stick €5,000 into a different company every single year, and it creates a continuous stream of reducing your tax bill and getting money for yourself, because you're getting money tax back in year 1 and a return from the company in year 4. And after a while, the scheme kind of becomes self-financing because you're getting, you know, the money on an annual basis if you do it every year. So again, something that's really, you know, underused and underappreciated. Step 5 is to avoid debt where possible. You know, I'd like for everyone to try to get into the habit of saving and investing for future expenses rather than relying on loans. And it's about planning early on, because the thing about loans is that they eat up even more of your disposable income, and they make it even harder to save and allocate money to your future. And as I said here, it's a vicious cycle. And realize the importance between good debt and bad debt. Good debt is obviously a mortgage. You know, you've low interest rates. It's for an asset that appreciates in value over time, and we need somewhere to live. Bad debt is things like credit cards, which I would put a massive, you know, beware sign over, and urge people not to, or well, kind of against using them on an ongoing basis and racking up credit card bills, because the interest rates on credit cards are really, really high. And unless you're clearing, you know, the majority of your balance every month, you know, they're going to cost you quite a bit. And obviously, you know, taking out loans for regular occurrences, you know, things like holidays, taking out annual loans or loans every kind of 2 years. Again, if you can avoid it, try to do so. Last but not least, step 6 is to regularly review your plan and keep in touch with your advisor. The reason for that is that circumstances do change and plans need to be altered. You know, people have new incomes, children, and you know, studies show that those that seek regular financial advice, it will prevent them making irrational, emotional-based decisions, like moving all their pension to cash when markets are low. I still meet people who move their pension into a cash fund when the last financial crash happened in 2008, and they didn't seek financial advice or listen to financial advice. And a decision like that can potentially cost people tens of thousands to hundreds of thousands of euro. And I'm not over exaggerating when I'm saying that, because what it done is just crystallized the loss and stopped them from making back, I suppose, any growth. And we know that, the best years in markets will follow the worst years. So it's about, keeping the long-term view in mind. And a financial advisor or a financial planner will help you, along that, I suppose, path, and prevent you making kind of mistakes like that. A company called Vanguard actually done a study on this a couple of years back, and they found that those who sought, regular financial advice actually earned about 3% more per year on their investments. They refer to it as advisor alpha, and a lot of it comes back to this, versus those who done a kind of DIY approach and invested themselves in on average. And I do find, even from our own perspective, the clients who engage with us most and speak with us most are in better positions financially, irrespective of their income levels. To back that up, Standard Life, which is, a large insurance company here, and in the UK, they done a survey a couple of years back, which showed that those who regularly use the financial advisor or planner had nearly 3 times the savings and investments of those that don't. They're more than twice as likely to have a pension. They're more financially protected. And as I referred to, earlier, it's all about, feeling more confident and more confident about your future. So just to recap on some of the 6 steps that I covered today. Step 1 is, getting into good habits, looking to free up some income, looking at how you spend your money essentially, and maybe making slight sacrifices now to look after your kind of future years. Step 2 is, again, freeing up more income by reducing costs and the things that we pay for. And we can help you by reviewing some of those things. And step 3 is about embracing investing. Step 4, be tax efficient in everything you do. Look at things like a pension, look at things like EIS, and understand that they are, really, really beneficial. Step 5, avoid debt where possible. And step 6, review your plans regularly and seek advice. So this is, a summary of some of the other things that Alpha Wealth can do for you, savings and investments, obviously retirement planning and pensions advice, and protection reviews. And we, are happy to offer anyone on the call a complimentary financial review. I've never ever met a client that I couldn't save money for, and I've never ever met a client that I couldn't better their positions. So, put me to work and let me prove it to you. So look, I want to thank everyone for taking the time to come on today, and I'm happy to open up this to kind of questions. If anybody wants to unmute their mic, they're more than welcome to ask a question, and happy to try answer.
We've also opened the chat as well, guys, and I know there's 1 or 2 questions that have come on that, so we're just going to respond to them. But obviously, if anyone does have any questions they want to just throw into the chat, we can leave it open for a few more minutes, and we will make sure we get back to everybody.
Hi, David. I have a question here. This is Gaurav. I just wanted to understand, is there any EIS scheme who invests their money in the housing scheme?
Typically, no, because the EIS scheme, Gaurav, is kind of there to support, progressive, maybe early stage Irish companies, and it doesn't extend to kind of building and development. So typically, no.
Okay. So the only company you advise in this scheme are the MX, and the another one was liquor company. I forgot the name.
Yes, Kinsale Spirits.
Kinsale Spirits, yeah.
Yeah, so like there are, thousands of companies every year that will try to raise capital under this scheme, Gaurav, and as you can imagine, we have a lot of clients that are looking for ways to reduce their tax bill. So what Alpha Wealth does is every year we kind of scurry around and we look at some of the companies that are trying to raise money under the scheme, and we will vet them and run our due diligence, and we'll normally kind of pick, 1 or 2 or maybe 3 of the best of their type, and kind of, recommend them as a viable option to our clients under the scheme, rather than in just kind of investing blindly. And yes, 3 of those companies that we're recommending this year is Emex, which is a software company that actually has, ongoing revenues of €2 million a year, and Kinsale Spirit Co., which is a whiskey company, just launched their first whiskey in the midst of COVID last year, and have sold, you know, about 110,000 bottles already, shipping crates across to China and the US, and is selling in 156 super value and central chains throughout the country. So it just gives you an idea of, you know, that there are some really quality companies within the scheme, and it's not all kind of, you know, early stage startups. But look, it does come with its risks, absolutely.
Okay, that's perfect. Thanks, David, for the information. I'll send out an email to you to set up some 30 minutes time personally to get an advice.
No problem at all.
On this investment, yeah.
Happy to, and thanks for coming on.
Thanks. Bye.
Anyone else have any queries? So guys, look, if nobody else has any queries, that's my own contact details. Look, I appreciate you might want to reach out at a later stage, so just drop me a message or look, give me a call. And as I said, look, we're more than happy to, myself or Nick are happy to discuss any areas on today's presentation, or indeed any other areas of your personal finances with you. As I said, really do appreciate your time coming on. Look, have a great day and a great weekend, and look, hopefully look forward to hearing from some of the people. Thanks.
Cheers, David. Take care.
Thanks, Scott.
Thanks, David. Well done. Thank you.
Thanks, David.
Cheers, guys. Thank you.
Bye.